Hello everyone, my name is Laurie Itkin. I'm a financial advisor at Coastwise Capital Group. I have presented at the Cash Flow Expo before, the Wise Women Expo as well, and I'm really happy to be here. I'm known as the Options Lady, and I will not be talking about investing in real estate. I think they have me back every year because I talk about how to create cash flow doing something else other than investing in real estate. And the title of my presentation today is Create Options for Income in a Brokerage Account. What is a brokerage account? That is where somebody trades publicly traded securities like stocks, exchange traded funds, bonds, mutual funds. You can open one at any major financial institution like Schwab, TD Ameritrade, Fidelity, Wells Fargo, etc. And I am going to talk about something that is, they're conservative option strategies, and they're a way to generate additional income when you are investing in the stock market. So my contact information is here. Laurie Itkin, financial advisor with Coastwise Capital Group. You can reach me at this number or my email address, or if you just want to go to my general website, that's theoptionslady.com. So anytime we talk about investing, I have to go through this disclaimer that this is only an expression of my opinion. I'm not trying to induce you to follow a particular strategy. This isn't a solicitation to buy or sell equities or options. I want to make it clear that past performance is not indicative of future results, and I can't guarantee any specific outcome. Obviously, you all know that investing carries risk and that you may lose some or all of your principal. And before you embark on this strategy or any other strategy, it's always good advice to consult with a financial advisor or a CPA, etc., to determine your personal situation and whether or not this strategy is appropriate for you. Who am I? Who is Laurie Itkin? Well, about 8 years now, I wrote a book called Every Woman Should Know Her Options, Invest Your Way to Financial Empowerment. And it's all about how I made my first stock trade at age 24 using a $1,600 inheritance from my grandmother. And I talk about all the things I did in my life that led me to become a millionaire before I turned 40. And investing is just a key part of that. In a nutshell, I started investing and I just had the behavior that any money, I really lived below my means, and I made sure that I didn't spend more than I earned. Obviously, the first 10 years after college was difficult because I had to pay back college student loans. But I just talked about how investing became just a daily habit for me, reading the Wall Street Journal, learning how financial markets work. And back then there was no internet and it was harder to get information. And look, I did it, and I feel that any woman can do it. I also in the book talk about the option strategies that I'm going to talk about today, and obviously the book gives more examples and gives a better context than what I can do in just a 45 or 50-minute presentation. So I encourage you to check out the book. You can Google it, get it on Amazon, whatever. All right, let's look at stock market investing for income. The pros are that you have no tenants, toilets, or trash. You know, being a landlord obviously has its challenges, its burdens. It can be time consuming. You may have vacancies. I mean, I don't need to tell you all that because most of you watching this are real estate investing pros. The great news with the stock market is it's easy to diversify. You can invest in real estate through the stock market. There's real estate investment trusts, for instance, that are publicly traded. There are so many funds now that with a Schwab or a TD Ameritrade or Fidelity account, you can invest in so many things. It's not just stocks. What I love about investing in a brokerage account is you have instant liquidity. Typically, most things settle within 2 days. So if I have a client who tells me, hey, Laurie, I need to pull out $40,000 from my account, within 2 days, he or she can have that money to be transferred. It's a little more difficult to do that when you're investing in real estate. But what are the cons of investing in the stock market? Well, stocks are volatile. We have seen in 2022, the stock market crashed. After 11 years of going up, it crashed. The S&P 500 went down almost 20%, and the NASDAQ, which is mostly tech stocks, not all tech stocks, but growth stocks, that went down more than 30%. Now, another con is if you don't use options, the income you can get from stocks is limited to the dividends. If you are in a stock that actually pays a dividend, because not all stocks pay dividends, but many stocks pay quarterly dividends. So if you look up the yield, the annual yield of your stock, and the annual yield is 4%, you should expect to receive about 1% every 3 months. Of course, the dividend yield changes all the time because the stock price changes all the time. So almost like if you're renting out a house, the value of the house is going to change all the time, but your fixed rental payment until you raise the rent, you're going to know what you get every month. Oopsie. Okay. So, let me move this. Let me talk a little bit about the types of clients that I work with at Coastwise Capital Group. We're a registered investment advisor. We're independent. Schwab is our custodian, so our clients' money is at Schwab, and they give us the authority to drive the car, let's say that. We can never access the money, but we are directing how the money is invested. And here's examples of the types of clients. Retired. I have a lot of retired clients. One in particular, this woman, divorced woman in her 70s. She lived frugally and saved money throughout her life. She was a teacher. She gets 2 pensions, and she needed enough income, consistent income every month, so she could supplement her pension to pay her mortgage, to pay her bills, and things like that. So my job is, if she says, hey, Laurie, I need $2,000 a month extra, my job is to invest the portfolio through the dividends and the option premium that she can pull that money out without necessarily having to sell principal every time. Another client is one that she was between jobs, and she had most of her wealth concentrated in one stock because her employer, she earned restricted stock units and stock options from this employer. And so you can't usually do it when you're employed because there's a restriction typically. But if you've left a previous employer and you have all this money in their stock, a great idea to generate income is to sell call options against that stock. It helps you generate income from this stock you hold. And then lots of my clients are divorced single mothers. They get a settlement, and then they need to withdraw money periodically to pay for personal expenses, children's expenses that exceed child or spousal support, or they get to a point where there's no more support and they have to rely on their investment portfolio to generate income. So this is typical of what I do. What I didn't include here is that I also have clients that are parking money in between real estate deals, and I'll tell you how we address that. All right, here's where I'm going to tell you. Interest rates are very high right now, right? We've had, as you know, mortgage rates have doubled since the prior year, if even more than doubled even in some cases. And Right now, what I've taken is a screenshot of my Schwab trading platform for clients, and it shows you can buy CDs, invest in CDs through the platform. You can invest in different types of bonds, but what I've highlighted is the 6-month US Treasury, because at the time that I recorded this, that was yielding 4.82% interest on an annualized basis. That's really good. I mean, Treasury bills are safer than even CDs. So I can't say there's no risk at all. If our government collapses, there could be a risk, but it's a pretty darn safe place to park your money. And so what I've been doing for clients, especially clients who invest in real estate, I've been laddering some of these, like doing 6 months, doing 3 months, doing a year's, 1 year's, and that way they know that, wow, we bought them on this day, and that 6 months from today, I will have all my principal back to either withdraw the account because there's a real estate deal, or I want to reinvest it in something else. And it could be that interest rates will be higher or lower when these things mature, but this interest rate's pretty good. I'm excited about it, and I couldn't do this for the past few years. There was just no interest to be had in these things, very little. All right, now let's get to what I'm going to talk about today. Options investing, covered call. That is the main strategy that I do. And let me try to help you understand what this is. You could rent out a property for income, right? You could buy a property and collect rent on it. Or you can rent out your stocks. How does that work? Well, a covered call is when you buy 100 shares of stock in a company or an exchange traded fund, which is sort of like a mutual fund, but it's better because, in my opinion, it's better because it trades on the stock exchange, and that you can, it's traded like a stock. The pricing is throughout the day. You can also sell call options on some of these ETFs. So what you do is you buy 100 shares, or maybe you already have 100 shares of something when you come over to me. Then I sell one call option for income. And a call option, we call that income from a call option, we call it premium. It's called option premium. And so you are buying 100 shares of stock, or you already own 100 shares of stock, and you sell one call option, and immediately, the minute you sell that call option, income, cash comes into your account. And this can be used in both a taxable account or an individual retirement account, an IRA, because it is one of the most, if not the most, conservative option strategy. And so conservative option strategies can be used in an IRA. Some strategies cannot be because they're risky and with good reason. So I have a picture of a light bulb because when I learned about this concept, I thought, oh my gosh, I've been investing in stocks since I was 24, and I'm like, oh my gosh, you mean the Starbucks stock that I held, I could have been generating income on this thing the whole time. All I needed to do is, if my stock was trading at $100 a share, I could agree to sell it at $110 a share in the future, maybe 3 months, 6 months from now, and get option premium today. And then when that option expired, I could do it again. And I could have been renting out my stocks this whole time. So the light bulb went off. Now, you've probably heard that options are risky. I mean, I'm also a divorce financial planner, a divorce financial analyst, and I get my share of cases where one spouse was a day trader and used options, and there were lots of losses. I'm sure there were also lots of gains, but that they're probably still married if there were lots of gains. They come to me when there's bad news. So, yeah, options can be very risky. There are many option strategies I refuse to do for myself, and I refuse to teach, because mostly options are used with leverage. It's a way to speculate on big price movements, either up or down. When you buy a call option or you buy a put option, you are betting that the stock is going to move up or move down. And typically, in order for you to make money, it's got to move up a lot or down a lot within a short period of time. That's a generalization, but that's really what I would say if I was simplifying it. Very speculative, because you could lose your whole investment. If you buy a call option for $100 and the stock price doesn't move up enough in the time period before the option expires, you can lose 100% of your investment, 100% of your principal. I don't like that. But when you do a covered call, when you write a covered call and you already own the underlying stock, then believe it or not, selling a call option is less risky than just owning the stock by itself. Why? Because when you own a stock by itself, particularly if it doesn't pay dividends, how do you make money? You only make money if that stock moves up in price. And you only make money if you sell the stock after you bought it and it moved up in price. But when you sell a call option, if you already own that stock and you've already said, I'm taking the risk of the stock going down, at least if you sell a call option, you've brought in income today, guaranteed income today, to offset a loss that you may have. It's not going to fully offset the loss, so you have to be careful about what stocks you pick, and it won't fully offset that loss, but it can partially offset that loss, which is a very good thing. What type of stock to use for covered calls? I mean, you can learn the strategy, but if your underlying portfolio is crappy, it's not going to work out very well. So, one of the types of stocks to consider for covered calls is what we call the dividend aristocrats. The dividend aristocrat. You can Google it. What is it? A company is a dividend aristocrat if it has increased the dividend it pays to shareholders for at least 25 straight years. Increase the dividend. You know, in 2008 or even in recent times, a lot of good companies have cut their dividends where, people are expecting every 3 months to get that dividend income, and then they reduce the dividend or they cut the dividend. So I like to know that the stocks that I'm buying for clients, that they've consistently paid dividends, and not only consistently paid dividends over the years, even managed to increase those dividends. It's usually a sign of a fairly healthy company. Not always, but it's a good sign. So dividend aristocrat must also be a member of the S&P 500. So they'll tend to be large established companies. They're not going to be something like a Peloton. They're not going to be something that's not been around very long and doesn't pay a dividend. And the one thing is that if you are getting a dividend paying stock and you're using that for covered calls, you may not get the same returns you would if you used a more growth oriented stock that has higher beta. I'm getting into a financial technical term, but a stock that has more volatility, and typically but not always, stocks that pay dividends, typically but not always, have less volatility than those that don't. Again, I'm making a huge generalization. There are many exceptions. All right, so let me show you a tool I use, Born to Sell. Born to Sell is a platform that you can subscribe to, and I love it because, and I'll show you examples of it, it just is a tool to quickly show me my potential returns on trades that I make, on options trades, on covered calls specifically. And the one good thing about here is they have, I think they still have a 2-week trial and free trial, and you could actually use your 2 weeks to take this covered call tutorial, and similar as what I explain in my book, Michael, who's the founder of Born to Sell, he gives you a sort of a book on the platform and explains how to do covered calls and why you should sell call options rather than buy them. So I encourage you to take a look, Born to Sell, at least read the tutorial, see if you're interested in my presentation today, the next step, read the tutorial, see if that interests you, and then this is a great platform to use if you are going to become a covered call trader. So let me give you some examples. Okay, now, we're going to get some math here, and I may need to put my reading glasses on. Let's take a dividend aristocrat. Procter & Gamble. We've all heard of Procter & Gamble, been around forever. Dividends modest. Currently, the annual yield is 2.6%. So remember, if you were to hold the stock for a year, you would expect to get about 2.6%. So if you bought $1,000 worth of Procter & Gamble stock, you could expect to get $26 throughout the year. All right. Again, things change. The stock price is going to change up and down, so the ultimate yield may change, but you get the idea. Now, 2.6% a year isn't much to write home about. So you can sell a call option on the stock to boost the yield. Instead of renting out at 2.6%, maybe you can rent the stock out, get a little more. So let me show you how to read this Born to Sell platform. What I've done is I put in PG, which is the symbol for Procter & Gamble. I've chosen an expiration in July, a monthly expiration, and that's about 6 months from when I recorded this, because I recorded this in late January. And so I just chose a 6-month option. You'll find when you trade options, there's monthly options. You might be able to do a 2-month option, a 6-month. Not every month's available, but in January, there's a lot of June and July expirations available for stocks. So for our math purposes, to make it easy, I thought, I'll do a 6-month expiration because that's easy to understand. So when I ran this, you can see that Procter & Gamble, one share was trading at $151.12 a share, $151.12. Okay. So if I bought 100 shares, because I need to use 100 shares for one covered call, if I bought 100 shares, my investment would be $15,112. Okay. Now, how do I make the money? Well, I could just hold the stock, and I'm pretty sure I'll get 2.6% on my money. However, I could do something else. I could sell a call option. I could sell this 155 strike price. What does that mean? That means is that I'm going to agree to sell my 100 shares of stock at $155 a share. If it gets to that price, I'm agreeing that any time between now and the third Friday in July, if that stock price goes above 155, I've agreed to sell it at 155. So over the next 6 months, if in July the stock went up to 154, I don't need to sell it. If it went to 156, I may need to sell it at 155. So why am I doing this? Because check out the bid. If I sell this 155 strike price, I get $675 in my pocket, in my account, not really my pocket, my account, guaranteed the day I sell this, right in 1 minute. I can just do it if the market's open, okay? Now, of course, these prices change by the hour, by the minute. But let's think about this. If I have invested $15,112 and I can get another $675 over 6 months, and I only have to sell the stock if it hits 155, which means I'm allowing the stock room to appreciate, because most people buy stocks because they hope it will appreciate. Well, then my return, even if the stock doesn't go up even $1, let's say the stock stays flat, my return over 6 months is 5.3%, not even including the dividend. Why? Because by getting $675 on my investment of the $15,112, I'm making a 5.3% return over 6 months. Annualized, because it's not quite 6 months, but an annualized return would be 10.2%, just so you can compare this. I also may get 1 or 2 dividends because dividends are paid every quarter on Procter & Gamble. So the other thing what this does is by selling the call option, I get downside protection because my investment can go down each share of stock can go down $6.75 from the price I paid before I take a loss because I got the income, right? I'm getting $6.75 for every share, the 151, 112. So really it can go down and drop below to 140 something and I'm whole. Okay, there are different strike prices here, but I'm not going to get into that because this is what we call a slightly out of the money strike price. We are choosing to sell the strike price that's immediately the one immediately available that's above the current stock price. Okay, so I can either just buy Procter & Gamble like everyone else does and collect my little dividend, or I can sell a call option. What's my risk? Well, if the stock goes up to 160, I had to sell it at 155, but I still made a gain on the stock. I still got the option premium, and I might have gotten the dividend. So, and if the stock goes down, because I got that option premium, I got paid a little bit as a little cushion. Okay, so that's Procter & Gamble. Now let's give another example. IBM, another dividend aristocrat. IBM, I like this dividend, 4.7%. That's pretty good. Now, I mean, that's very good for a dividend. That's on the high side for a dividend. Once again, I can sell a call option on the stock to boost the yield. And in this case, when I ran this, IBM was trading at 146.25 a share. And I can choose the 150 strike price, the first strike price that is slightly higher than the current price, and I get call premium of $780 in my pocket. So I buy 100 shares, which means I make a $14,625 investment, and I get $780 if I sell this call option. If the stock stays flat, my 6-month return is 5.6%, and if I get the dividend once or twice during that 6-month period, you can see the yield will be even more. What else do I want to say about this? What happens? What happens in the 3rd week of July when this expires? Well, if the stock hasn't hit 150, I keep the stock, whatever it's trading at, and I can sell another call option. Woo! I go in my option chain and I look and I go, I can sell another 1-month option, maybe a 3-month, maybe a 6-month, maybe go out a year. So there is some work to be done because every time the option expires, it's either going to expire worthless, which is what you want, because you'll keep your full option premium that you got when you sold the call option, and then you still have the stock and can do this again, sell another call option, or the stock got called away and you no longer have the stock, but you have all the principal that you paid for the stock. You have the call option premium you got. You might have gotten some dividend income, and then you can have a new investment opportunity. Now you got to figure out, maybe there's a different stock that I want to buy. Okay, so now I'm going to show you Apple. Apple pays a small dividend, but it's not a dividend aristocrat, but for some reason it is one of the most popular stocks for covered calls. Now you'll notice my return profile is a little more juicy on Apple because it is a tech stock. It's more of a growth stock. And if I, in this case, again, doing 6 months out, if I choose, this one I like, I'm going to show you an at the money call. So here 100 shares would cost me $13,446. I could sell the strike price, the call option, that's like right above, right? 135 is almost the same as 134. But in this case, I get $1,260. There's my call bid. And then my downside protection is 9.4%, meaning that Apple can go down, the stock price can go down 9.4% before I'm hurt, before I take a loss, because I got the income from the call option. So in this case, over 6 months, my return, if Apple doesn't even go up a penny, is 10.3% over 6 months. Annualized 19.8%. Again, this is slightly different because it's not exactly 6 months. That's why the annual return isn't double. I like this one because I get downside protection. However, if Apple goes to 140, 145, 150, I still have to sell it at 135. But do I really care because I've gotten a good return? Okay? What the covered call strategy does is it caps your upside potential in exchange for some downside protection. And I mean, how often do every stock we pick go up all the time? Even if we're not a stock picker and we say, you know what, I'm just going to be in the S&P 500 fund. I'm just going to be in a diversified mutual fund or exchange traded fund. The S&P 500 went down 20% last year in 2022. So you will never, I don't care who you are, you will never consistently pick stocks that always go up. So this is managing your risk. Now, you're doing this for income in a brokerage account, but you can also do this in an IRA. You just aren't collecting the income. The income's going there sort of as a hedge. You're getting income to offset a partial loss. Okay. Now, enough on covered calls. You want to learn more, get that, either read my book or get the tutorial. The tutorial on Born to Sell is free. Now, let's go to a different strategy. I use a shoe analogy for this. Get paid to wait to buy stocks on sale. You are getting paid to wait. Paid to wait, I like that, to buy stocks on sale. My analogy is shoes. So, I see these black sandals. They're selling for $200 at Macy's. Macy's always has sales. I mean, gosh, things are 10% off, 20%. They always have sales. Unless I need these shoes right now, I really need to buy these shoes. I mean, just like when I'm shopping for stocks, like, do I really need that stock? There's other stocks I can buy. But so if the stock is trading at $200 a share, why would I pay $200 now when I know that Macy's is going to have a sale? I could potentially come back and buy them for $180 a month from now. I could also potentially buy stock that's trading today at 200 and agree to buy it a month from now or 6 months from now if it falls to 180 or below. So if it falls 10%, I'd rather buy the stock at a lower price, wouldn't you? I'd rather buy the shoes at a lower price too. So in this scenario where Macy's says, hey, I'm going to have you wait, and if you wait and you commit to come back in a month and buy the shoes on an agreed upon sale price, I'll give you a cash credit today. This is a put option, friends. What this means is that there's a stock trading at $200 and I can sell a put option and agree to buy 100 shares of stock only if it's trading at a lower price. I only want to buy this stock if it's trading at $180 a share. And I'm going to get put option premium for agreeing to do that. So I like to do this a lot, especially when stocks have been depressed. So if I take a stock like Disney, and I don't know, I don't have a slide right now, but let's just say Disney has fallen 40% over the past year. Again, don't quote me, I'm not sure. And Disney's now trading at $100 a share. Well, I can actually sell a put option, get money today, like that call option premium, I'd just be getting put option premium, and I don't have to buy 100 shares of Disney stock unless it falls from 100 to 90. Unfortunately, if it falls to 85, I still have to buy 100 shares at 90 because I've chosen an option, a strike price of 90, but I might have gotten $5 to do this. So I spent more time on covered calls. I just want to introduce this concept to you to say that if you have cash, if you don't have the stock and you have $10,000 lying around in your account, you could buy, 100 shares of a stock trading at 100, which would cost you $10,000. Or you could say, I'm going to sell a call option and I only want to buy that stock if it falls from 100 a share to $90 a share. And in which case, I would be paying $9,000 for the stock, not $10,000. But I would also get put option premium. I can't tell you what that's going to be. We'd have to look at what's called the option chain. But I'm going to get money. I'm going to get paid to wait to buy stock at a lower price. That's more conservative than just buying the stock today at 100. But I may not get the stock. If the stock doesn't fall that low, I may not have to buy the stock and I keep the option premium. And when that put option expires, I can sell another put and get income. But I have to be ready to buy the stock at the price I agreed to pay for the stock if it falls to that price or below. Why is selling a put option less risky than buying stock? It sounds pretty scary. I'm selling a put option. What the heck is that? It sounds risky, but it's less risky than just buying that stock at today's price because I'm getting paid option premium now in my account for the obligation to buy stock at a lower price in the future versus buying the stock at the current market price today. This is an ideal strategy for using up capital loss carry forwards. So I had a client who was divorced and her husband was still, I don't know what he did in 2008, 2009. He panicked, he sold the stocks, and they had like a $600,000 capital loss carry forward that they got to share because they were divorced, so they each took it on their tax return. She has a capital loss carry forward. I can sell put options all day long. I don't really mean that all day long. I can sell tons of put options, which are typically taxed as short-term capital gains tax. And she doesn't have to pay tax. This is like tax-free income to her because she'll have short-term capital gains from the put options I sold throughout the year, but she has these capital loss carry forwards that can be used to offset her tax obligations. So whenever I see anyone with tax loss carry forwards, I say, this is a gold mine. Yeah, you got them because you lost money in the past, but now we can sell call options. I can generate essentially tax-free income for you, especially if you're in a state like California that has a high state income tax. This income is going to be shielded from federal and state income tax because you have the capital loss carry forwards. If we were just to buy stocks, she'd have to pay tax on the dividend income. If we were to buy bonds, she'd have to pay income tax on the bond interest. So just keep that in your brain that if you have capital loss carry forwards, selling a put option might be a really good strategy until you use most of those up. Okay, so we're about 40 minutes through. We've got a few more slides. So, oops, let's go back here. Okay, so these strategies, covered calls and selling put options, they can be used in a taxable brokerage account or an IRA. And my firm, Coastwise Capital Group, we're a boutique firm in La Jolla, California. We have clients all over the country. And in fact, we have some clients in other countries. Certain countries, you are allowed to be a resident of certain countries and have a U.S. brokerage account. Not all countries you can do this. So how are we different than a regular financial advisor? Well, most financial advisors typically charge, let's say, 1% assets under management, and many of them will have an ETF only portfolio where you can only, they're going to invest your money in exchange traded funds, ETFs. They'll do some sort of allocation, 60% stocks, 30% bonds, 10% gold, or large cap stocks, international stocks, that kind of thing, all in exchange traded funds. Or you may find some financial advisors who do have individual stocks. What we do at our firm is that we actually also have custom portfolios. So your account isn't cookie cutter like everyone else. I've noticed from doing this for many years, many clients will say, hey, I want to buy this biotech company, or I want to buy this EV company, or whatever. I want to invest in AI or what have you. And with most financial advisors, they won't let you do that. They'll say you have to invest on your own because we can't put that in our portfolios. Well, at Coastwise Capital Group, we custom make your portfolio. We may try to talk you out of it if you want to invest in a bunch of cryptocurrency. We'll encourage you to what we call position size it. That's what we do as financial advisors. Maybe 2% or 3% of your portfolio. As long as you're not putting 50% of your wealth in crypto or something else, whatever the next fad is. So we for options strategies, we typically require a $500,000 investment minimum that can be achieved by a variety of accounts. You might have several accounts to make that $500,000, and we charge a percentage based on assets under management, and that varies between how much you are investing with us. Or because we love covered calls, my colleagues and I. One of my colleagues will do training where you do it yourself. You learn how to trade the covered calls. You just need an account with an online broker. It can be an IRA. It can be a brokerage account. We recommend, at least 50,000, just because, as I explained before, you need 100 shares of something to do this, and you figure if a company's trading at $50 a share, 100 shares is going to be $5,000, and you want a diversified portfolio, maybe you have 10 different positions, or you can do this on ETFs. And you take one-on-one training sessions with us. We use Zoom. And I have a couple of colleagues that will do this. So in terms of wrapping up, let me just summarize. Let's just summarize. And this is me. This is the way you can get in touch with me, theoptionslady.com. If you can't remember any of my contact information, theoptionslady.com. But to summarize, what did I teach today? What did I introduce you to? I showed you a way that you can generate income and cash flow in a brokerage account using something other than real estate. Covered calls. You need to purchase 100 shares of stock or certain exchange traded funds, ETFs, or you already have 100 shares of stock. Maybe you're coming to us from another firm or your own stuff, you already have 100 shares. We sell a call option. We determine what month call option to pick because they have different months, they expire. We determine what strike price to use. Are we going to, the higher the strike price is from where the stock is trading at, the less call option premium you get. The ones that I showed you, like that Apple trade where I showed you the strike price that was not even $1 higher than the current price, you got a lot more call option premium for that. Why? Because you are agreeing to cap your upside potential in exchange for guaranteed income today, which gives you more downside protection. So this is so much fun doing this because you get to manage your risk. You get to decide how much room you want your stock to grow by capital appreciation or how much downside protection you want. There are 3 profit sources when you do covered call investing. When you buy a stock, you hope there'll be capital appreciation. You'll buy a stock and hope over time it goes up in price. You may earn a quarterly dividend. And if you sell a call option, you get call option premium today. And in fact, the only one of those 3 profit sources that is guaranteed is the call option premium. You decide how much income you need to generate. I have clients that say they mostly want the stocks to grow and have room to appreciate over time. So they want me to sell, if the stock price is here, they want me to sell call options up here. They may only get a few percentage points in call option premium every year, but the stock has room to grow. Or I have clients that want the call option right above the stock price because they get guaranteed income today and they don't really care if the stock has to be sold. We'll just take our principal and redeploy it somewhere else. So, in summary, 2 of the most conservative option strategies are writing covered calls, buying 100 shares of stock and selling 1 call option, or selling a put option whereby you get paid today to wait to buy stock at a lower price in the future. There are risks to both strategies. The risk is that if your underlying stocks go down 40%, your account value won't go down 40%, but it'll go down a lot. Okay, maybe not 40%, but it'll go down. So as we saw in 2022 for our clients, if they were in stocks, most of them had a loss in 2022, but the loss was less severe had we not had the options strategies applied, overlaid on them. So I hope you found this interesting, piqued your interest. There's tons of things you can learn on this, tons of books written about covered calls and short puts, cash secured puts. Reach out to us if you are interested in learning more. I'm Laurie Itkin. I'm the options lady, and it's been wonderful to be with you today. Enjoy all the other presentations at the Cash Flow Expo. Thank you.